Hey, this is Trader Travis and welcome to another video in our free training series. If you want to get the complete free course, just go to our website, learnstockoptionstrading.com. It'll take you through a web-based course from start to finish and give you the process I use to trade options. Now, in this particular training video, what we're going to do is talk about in-the-money options. Now, this is the third of three videos that we were recording. The first one I recorded, I talked about out-of-the-money options. The second one I recorded, I talked about at the money options. And now in this one, we're going to talk about in the money options. And so what I'm going to do is pull up my broker's charting platform or trading platform right here. And if you've been following these videos for any length of time, you know what I'm about to say next. And that is, I am not going to define an option chain for you. Just go to our website here, learnstockoptionstrading.com/stock option chain. Because of what it is, it's a tutorial on what an option chain is and kind of explain it. It keeps my recording time down in these videos. And so that way you can go through this tutorial, learn what an option chain is, then come back here to this video and kind of understand what I'm talking about. And so, right now we're talking about in the money options. So in the money options will be these shaded ones here. And in the money option will be one. Let's talk about call options first, because we have calls and puts. And so call options give you the right to buy a stock. Put options give you the right to sell a stock. Now, we're just talking about buying options. We're not going to cover selling options. We cover that in our coaching program. But buying options, okay, so in the money for a call option will be the strike you can say it either way. I'm just going to say the stock price, where the stock price is trading above the strike price. Okay, stock price is trading at about $734, so $733.99. All right. Now the stock price is above the strike price. So anything above these strikes here, these are the exercise prices. If people own an option contract, this is the price that they can either buy or sell Google at. Because we're showing an example of Google. Okay, so the stock is above 735. It's above 730. Excuse me, it's above 725, 720. All these. All right. So if a person owned this contract right here, this call option, they would have the right to buy Google for $710. If you look here, Google is currently trading in the open market at 733, almost 734. So it's like buying something on sale. You get to buy it at a discount. And that's why it's called in the money. Okay, you're essentially in money. You're going to make a profit. You're going to exercise your contract and buy something for a significant discount, about a $20 discount or so, give or take. Okay, so that's the easy way to think about it. In the money. You're actually going to make money. All right. So for put options, it's a little different. We come over here, and for put options is going to be where the strike is higher than the market price of the stock. All right. So we're going to come all the way over here. All right. Put options give you the right to sell something. Put options are actually one of the oldest forms of hedging or assurance. Hedging is just a complicated word for saying assurance. There's something called stock insurance. Mutual funds buy stock insurance. Stock traders will often buy stock insurance. If they buy Google for a share price, they might come over here and buy a put option because put options give them the right to sell the stock at a set price. And so these options right here, these put options right here give people, whoever owns these September 750 put options, it gives them the right to sell Google for 750. So if you're in a position where your stock is crashing in price, you own a put option, you can come here and be like, you know what? I bought Google at about, let's say you bought Google for 750 and you wanted to protect that worst case scenario, you get out at the same price you bought it at. And so as soon as you bought Google, you bought, a 750 put option. Let's say fast forward, Google crashed in price. You're now looking at it. Google is trading for 733. You're like, no problem here. I have a put option here to protect me. This put option gives me the right to sell Google for 750. You have the right to sell it for something more than what it's currently trading at. And so this is a legal contract. You call your broker will come in here and execute your order and you'll sell your shares for $750, even though Google is trading for less than that. Yes, it sounds unbelievable once you trade options and learn the legalities and all the ins and outs of it. It'll make complete sense. But anyway, this put options is in the money. It allows you to still profit even though the stock is trading at a lower price. So that's one way to think about in the money for put options. Now, real quick, I'm going to go through an example again, same example I went through in other videos where we bought put options. Now, I have the Greeks pulled up this time. I won't cover a lesson on the Greeks, but, stock traders are more familiar with in the money options, and I won't go over the pros and cons, but there's a really cheap way to trade stocks that I don't want to call it an insider secret, but it's surprising how many people don't know about it. There are stock traders, instead of buying hundreds of shares of stock, they'll come in here and buy a call option, a deep in the money one with a delta of about, close to 90 to 1, because it has a very close dollar for dollar move with the stock. So if the stock moves up $15, the option might move up $15. So let's just pick this 675 here. All right. So if we bought this, it'd be 60 times 100. So it'd be like, that's a lot of money. Actually, let me root this up for you so you can see it. Okay. And so it's showing 59. So 59 times 100. So about $5,900 per contract. That's how much you want to buy. Okay, well, you think that's a lot of money. Well, each contract represents 100 shares. So think of it this way. You're picking the 675 strike. So 675, buying Google at $675 per share times 100 shares, that's $67,000. That 5,000 looks more attractive now. Okay, so now let's look at this. We're going to fast forward in time. Google went up in price. That option you bought, 675 call option, is now here. Let's go ahead and sell it. You can see a profit of 1570. All right. So if you watched the last videos, you can see our profit has gone up from 7. The last profit was 1100 for the at the money. So out of the money profit was about 700. At the money was about 1100. Now with the in the money, you can see the profit is about 1570. Okay, so now let's do our profit and loss. I'm going to tell you right now is going to be, the return on investment is going to be less, but you can see you make money. So that's the trade-off there. Divided by $59, which is going to be our entry price, or actually $5,900. And so you can see now the percent return is only going to be $26. $26, gosh, 26 or 27% return on investment. All right. So way less percent return on investment, but you made more money. All right. And so what I talked about earlier is I said some stock traders will, buy in the money options is a cheaper way to take advantage of the movement in the stock. So if you look here, Google traded at 733 back then. We come forward 2 days later, it's at 749. So 749 minus 733. So the stock went up $16 in those few days. All right. Times 100 shares. So if you owned 100 shares, you'd have made $1,600. However, remember the investment outlay, you would have had about $67,000. You had to, pretty much come up with that money. But look, here's what a cheaper way is. You invested about $5,000. Let's just round up $6,000, and you essentially made almost the same profit. Okay, without the initial investment. So that's one of the secrets to how stock traders use in the money. There's a lot more to it. I'm not giving you investment advice. It's not that simple. It may seem simple, but this is just a very oversimplified example just to explain to you the difference between, what an in the money option is compared to the other ones, at and out of the money. Okay, so that's it for this training video. I'll see you in the next training video. And remember, before you leave, just go ahead and subscribe to our YouTube channel or click on the link below, and that'll take you to our website. You take care, and I'll talk to you soon. Bye.